afternoon. Good afternoon. Welcome to our first March webinar, Insurance. Why does it cost so much and what can we do? I'm going to do all these webinars as, this is our first March webinar or this is our second March webinar. They can all have, an important date. So before we get started, we are going to do some housekeeping. My name is Alina Gilbert. I'll be presenting today's webinar. And thank you for joining us, first and foremost. We really appreciate you guys attending these. And on your screen, you will see the bulk of your screen is our PowerPoint. And then sort of off to the left, you'll see a smaller picture with your presenter. Hi, me, presenter. All right. On the right side of the menu, you will also see a little chat icon. That is where you are going to type in your questions as we go through this. I am going to take all questions at the end because I want to make sure we get through all the materials first. And honestly, I don't think we're going to have any trouble getting through everything on time. So we should still have plenty of time for questions, and hopefully we can get through all of that. Now, if you're having any audio or video issues while we are going through this, there is a little kind of button thing on the bottom that says audio or video issues question mark. Click on that. It's going to take you through a few steps and hopefully resolve the problem. Okay. You will be issued 1 CMCA credit for attending today, so make sure you stay on until the end of the presentation. You will get it emailed to you within 24 to 48 hours from when we do this class. Keep in mind, it's really weird how they get emailed now because you pretty much have to open it right away and save it to your computer. Otherwise, they somehow manage to disappear. So I'm giving everyone kind of the heads up that just make sure when you get your email, you are automatically opening the certificate and you're automatically saving it somewhere so you don't lose it. Okay. Also, your certificates are not transferable to anybody else. They're just for you. And if you don't see your certificate or you have issues with your certificate, please email us at education@altitude.law. Okay. And we will see what we can do to help you. Also, these sessions, these daytime sessions are all recorded and then they are on our YouTube channel. So if you've got folks who weren't able to make it today and they ask you, hey, do you know if this session was recorded? It is, it was, and they can definitely access it if they go to our website and go under education. And then there's a little option to click on ACE YouTube channel kind of on the right hand side, and then all our daytime webinars are on there and I can watch any of them. It's no charge. We just can't give credits for those. Okay. Finally, last but not least, there will be a pop-up survey when I'm done talking. If you have the time and inclination, we always ask that you provide us some feedback. That is the only way we know how we're doing. Since I can't see your faces, I can't see if you're smiling at me or frowning at me or making hand gestures that are either favorable or not. So the only way I know if you enjoyed this presentation or if you didn't, or if you want something, different, is if you guys answer and give us your feedback in the survey. So please, 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 if you have time, please go ahead and submit some feedback for us. All right. So without further ado, let's talk some stuff. Let's talk some facts. And I actually did quite a bit of research on this because I thought, you know what, it's going to make a lot more sense to all of us if we understand kind of the background and we understand what kind of a market Colorado is with respect to insurance. It made a lot more sense for me as I did this research, and I felt very enlightened, and hopefully you will as well. But generally, facts are facts, right? They are what they are. So insurance companies are businesses and they want to make money. They need to make money to stay in business. It's not any different than altitude community law. We're a law firm, we're a business. We need to make money or we can't do anything, right? Management companies need to make money. Everyone needs to make money. Associations need to make money so they can provide the services they need to provide to their communities. Very, very simplistically, I'm going to say that insurers make money basically by receiving their premiums, and if they're paying out more than they're getting, they're not going to be making money. Again, extremely, extremely simplistic. This is by no means a business formula, but just in general. So then let's look at some facts when it comes to Colorado. And I'm going to tell you some more facts that aren't on here that are also really interesting. So we have a double whammy in Colorado because we have two big things that happen that cost insurers a lot of money. We have the wind and hailstorms and we have wildfires, especially like in the mountain communities or close to the mountains, the foothills. Our wind hailstorms, we're considered one of the most hail-prone states in the United States. In the last 10 years, our hailstorms have caused more than $5 billion in insured damage in Colorado. Okay, that's a lot of money. Our wildfires, especially in the mountains, if we just look at the Marshall Fire alone, just that one fire, over $2 billion in insured losses, just for one fire. We are ranked second or third, depending on where you look, as far as wildfire risk in the country. So we are absolutely up there. Now, there are other reasons insurers lose money in Colorado besides this double whammy here. We are also extremely litigious, and we have a lot of bad faith insurance litigation that happens in Colorado. I'm not saying it's not well deserved, and I'm not saying that they're wrong, because in most of those cases, the associations prevail. And Colorado courts tend to award more in damages than some other courts in other states. Okay, so all that together makes us a very risky state. So the way insurance companies decide on fees is they actually have categories for different states for their property policies. And, you know, in that kind of, they have big categories of how risky they are. And the things they do look at is, you know, yes, the wind, hail storms, the wildfires, but then they also have a risk of how litigious those states are and what kind of awards associations and owners are getting against those insurance companies. So Colorado is in like the top 7 as far as what are the riskiest states. So we are kind of in that upper echelon of insurance rates as far as insurance companies are concerned. See, I learned that, and that's kind of interesting. Now, a few things to be aware of as far as premiums go for us. Our premiums in Colorado on average are about 38% higher than the national average. So just so you know where we fall into all this, we're not the highest, but we're about 38% higher than the national average. On average, our premiums have increased from, if you look from 2019 to 2022, we have increased about 52% as far as our premiums. Between 2023 and 2024, we increased about another 20%. A lot of you are probably saying, well, yeah, we can see that in our numbers for our own communities. That sounds about right, Alina. So I want you to kind of keep that in mind, is that all of these increases are, again, it's a 3-factor thing. It's got wind and hail, we got fires, and we got a very litigious state. Okay. All right. So we're seeing some pretty drastic consequences from all those things. And again, I'm going to talk about a few things that aren't necessarily on here either. But what are the consequences of all this stuff that's happening in Colorado? Well, one is we've had some insurance or insurers that basically have said, you know, we're not going to write any new policies in Colorado anymore. We've had Allstate. They've stopped writing new business through Esurance, and we've had American National stop writing insurance policies in Colorado. Okay. We now also have higher premiums by our regularly admitted insurers. And we have, as you know, higher wind hail deductibles in Colorado. And then we have these excess and surplus lines of coverage that are available and that are much more expensive. So I'm guessing a lot of you already have experience with that because you've had to purchase insurance through these surplus lines of coverage. But it's important to know what these are. So these are insurance companies that aren't necessarily admitted in Colorado. They're admitted in other states, okay? But they're just not admitted in Colorado. Now, as a result, that doesn't mean they can't insure in Colorado, but it means if they are insuring in Colorado, they got to pay some stuff that admitted companies don't have to pay. So they've got to pay taxes on their premiums. So their premiums are going to be more expensive than admitted companies. That's one reason, is because they're paying taxes on them. And they have to pay into a state fund that basically insures the people who buy insurance through this company. If the company goes bankrupt, that they're still going to get paid out. So essentially, it insures the payouts, even if the insurance company goes away and goes bankrupt. So it's got to pay into that. So for that reason, you know, they're charging much higher usually premiums. But the good news with these excess lines and surplus lines is they can also provide insurance that admitted companies can't provide. They're not subject to the same restrictions, which means they can insure things. For example, we'll talk about later how grills is a big thing. You know, most admitted insurers aren't going to want to insure a community that has grills. Well, guess what? If you really don't want to ban grills and you want to have grills, you can probably get coverage through one of these surplus lines. It's just going to cost you. So they can insure things that perhaps admitted carriers cannot. So it's really a matter of, do you want the insurance regardless of cost or not? Also, communities that have lost their insurance, they've become uninsurable with respect to admitted carriers, you can then go and get an excess or surplus line of coverage because they are much more willing to insure these types of communities, the high-risk communities, and they will insure those communities. And as long as you can pay, you can get the insurance. So, you know, ultimately, this is what we have now. And this is what most associations are dealing with. They're either paying pretty high premiums on the regular lines that are admitted in Colorado, or they can't get that insurance, or they can only get partial coverage through admitted insurance companies. And so then they're going to the surplus lines to either get all of their insurance or some of their insurance. And ultimately, when you add it all together, it's a lot of money. And a lot of associations are struggling. So I want to take a look at the underwriters who are writing these policies and the type of things they are looking at when they are writing these policies. So remember, Colorado already is kind of in that upper echelon of pricing when it comes to insurance, because we are very litigious and we have the fires and we have the wind and hailstorms, right? So one thing they look at is the overall valuation of the community. There are some insurers who say when you take the value of the entire community as a whole If it exceeds $40 million, which a lot of them do, like if you've got a condominium community and it's pretty large, like you've got over 300 units or something, and they're expensive, or it's in the mountains or something like that, you're going to have a hard time finding insurance, because if it exceeds 40 million, you're going to get a flat out denial from a lot of carriers, because they will not insure for over 40 million, or they will only agree to partially insure. All right. Others are less risk averse and say it will only insure for up to 20 or $25 million. So associations that are, it's not even expensive. I don't think it's that expensive, but associations whose valuations come in over these amounts struggle and usually end up going to these secondary lines of coverage, because it's hard to find an admitted carrier who's going to get this for them. They're going to look at the age of the community. You know, the older the community, the more problems it's prone to have. For example, you know, the construction materials, you're going to have things like the polybutylene pipes. For those of you who don't know what that is, it was a pipe that was used way back when in construction. It was pretty common until they realized that it was very defective. There was a whole class action suit with it, and it was a big deal. And so now, if you're going to buy, you know, a home, or you're buying in a condominium or a townhome community, and you have an inspection, it's determined that there is polybutylene pipes, your insurance company is going to say, you better get those replaced before we insure you, because they're not going to insure polybutylene pipes. They're going to look at the roof age. And keep in mind, the age of the community is oftentimes very different than the roof age, because roofs, at least in Colorado, get replaced fairly often with all the hail claims we have. So you're going to have the underwriters looking at your actual roof age. When was the roof last replaced? You're going to look at the location of the community, because if you're in the mountains, chances are you're going to be paying far, far more for insurance than you are if you're in the Denver metro area. If you're in the foothills, you're going to be paying more than if you're in downtown Denver. These are all places that are much more subject to fires than downtown Denver, for example. So again, location matters. By the way, this meme is amazing. I love this meme. Okay, anyway, I'll move on. They're going to look at the type of community that we're dealing with. So for example, you've got condos that are stacked. You know, one condo catches on fire, it is going to spread to pretty much most condos, because they're all stacked and side by side. Townhomes, they're not, I mean, these standard type townhomes, they're not really stacked, but they do share walls. What if you have patio homes? Well, typically they don't share walls. So who knows, right? So depending on the type of the community and how it's, you know, structured, that could have an impact on the, at least on how resistant they may be to fires. They're going to look at what is actually insured by the association. What kind of insurance is the association required to carry? So for example, do we as the association insure the structural, just the structural components? Do we insure just the exterior of the building? Do we insure everything, including the units and all the finished surfaces and all the upgrades? You know, the more you insure, the more expensive it's going to be. Now, I do want to talk real quickly about an issue that I see, that I think most attorneys see, is that, you know, insurance companies are required, with respect to property insurance, they're required to insure to the specifications of the declaration. What that means is basically that if you ever look through your insurance policy, you're not going to see anything written out as far as this is what the association insures. It's never going to list things. It's not going to say we insure windows, we insure countertops. It's going to reference, you know, the documents of the association. And so then who is the deciding factor on what the documents require, what you insure, right? So unfortunately, if you don't have like a maintenance and insurance chart, your underwriter is going to be looking at this and saying, okay, well, I know what I'm doing. I know how to interpret declarations, and this is what the association is going to be insuring. Well, guess what? Yes, you may be an underwriter, or yes, you may be an insurance specialist, but no, you are not an attorney. And what you're trying to do is interpret a legal document, which I don't want to say you have no business doing it, but you're not an attorney. And it's not as simple as just reading it and saying, oh, it's this. There's a legal analysis that goes into it. And so this is what causes a lot of problems. A lot of problems when there's a claim filed, and now you start the fight of, is this insured or isn't this insured by the association? And then you have an adjuster. They come out and say, no, it's not. And you say, yes, it is. And then you have to get the attorneys involved, and it's a big mess. So I'm going to talk about this in more detail later, but there you can save yourself a lot of trouble if you have a maintenance and insurance chart that you just give the insurance representative so they can know, hey, I got a legal opinion, because your attorney has to make these. They're not made by the board. They're made by the legal counsel, and it specifically spells out who's insuring each component, association or owners. And then that way it's easy, and your insurance agent knows exactly who's going to be insuring what. Anyway, I'll move on. All right. Some other things that underwriters are going to be looking at. Aluminum wiring. I bet a lot of you, well, or at least some of you, have had a situation where you got a letter from the association's current insurer saying, oh, you have aluminum wiring. We are going to drop you from our current coverage unless by this date you have all the aluminum wiring either replaced or capped or whatever else they want you to do to address the fire hazard. And you provide us proof that this has been done. Aluminum wiring is a huge fire hazard, and insurance companies just are not willing to take that risk anymore. So that is big right now, and insurance companies are looking for that. Wood shake shingles, not as popular as it used to be, but that's also a fire hazard because wood burns, right? So again, that's something that could cause you to lose your insurance, or something that could cause your premiums to absolutely skyrocket. Outdated electrical systems, that has to do obviously with the age of the community. The grills on the balconies, we just talked about that, right? Most insurance companies are going to tell you that you have to prohibit grills anywhere in the community, anywhere within 10 feet from any building. And that's just is what it is. It's a fire risk, and they're not willing to take any chances. Open fires, same thing. Vegetation surrounding a community. So if you are a mountain condominium community and there's all sorts of sagebrush and trees around, where you are, that's a fire hazard, and insurance companies look to that, and that makes them very uncomfortable. Okay. And construction materials, of course, because if you have a building made of brick versus a building made of cedar siding, you know what the insurance is going to say. They're going to say, oh, we'd much rather insure the brick building, less of a threat of a fire, right? So again, lots of things. And we can't control a lot of them, but we can control some of them. And finally, just some miscellaneous components, criminal activity in the area. If your community is located in an area that's seen a huge uptick in criminal activity, that could also play into the premium rate you're going to get, because again, that's a risk. It's a risk that somebody's going to drive by and break your windows. It's a risk that there's going to be graffiti on the building, all sorts of things. It's a risk of car theft. They're going to look at the owner's responsibility to carry insurance. There is a movement that I've seen, and we'll talk about it a little bit later as far as what we can do about it, but there's been a movement, and I'm seeing more and more insurance carriers basically threatening associations, saying, you need to amend. Well, actually, I think what they're saying is you need to adopt a policy, but you can't really do it through a policy. But you need to require your owners to carry specific insurance, and specifically, they need to carry at least $1 million of liability inside their unit. Okay? And you need to require this. We'll talk about why that's not necessarily a great idea, but that is a movement among insurance companies to do that. They're going to look to see, does the association have any kind of security features? Again, you know, that could be both good and bad. For example, you know, you have cameras, you have gates. It might be good as far as getting a lower rate on your insurance, might not be so great for your liability exposure as an association, because once you take on the obligation to provide security, you got to do it right. So amenities, do you have amenities? Do you have a swimming pool? Did someone drown? Is that a risk? And then, of course, your claims history. They, insurance companies want to know, are you prone to making claims? And although we'd all like to think that one claim isn't going to cause too much damage to your premiums, these days, I got nothing. I've seen associations dropped over a claim. I've seen associations premiums doubled after they submitted a claim. So this is when I say go talk to your insurance broker, because they would know better than I what could happen with a single claim. It doesn't seem fair, but all right. Now we kind of get to the point that I think we've all been waiting for, and that is, what can we as associations do to lower costs? So let's talk about these things. The first one is kind of the biggest thing that associations are pushing, and that is require owners to self-insure or reduce association coverage by amending the declaration. And then it says, if allowed by law. Let's spend a few minutes on this one because it's important. So if you're changing insurance obligations, unless your declaration has a provision that says the board can unilaterally modify insurance obligations of both the association and the owners, if you don't have that language, it means you're going to have to propose an amendment to your homeowners, and you're going to need to get that requisite homeowner approval to pass that amendment. Okay? So first thing you should be thinking is, what exactly do we want to modify here, and how do we sell it to our homeowners, because we're going to need them to buy into this. What I see most associations doing is trying to shift basically the entire insurance obligation of the home to the owners. Now that's all well and good if you have a patio home that's detached. Even the townhomes that share a wall, I think you can do it. You know, the dividing line is right in the middle. You can do that. However, the problem really comes up when we are talking about stacked condominium units, because they're stacked. And so you don't own a lot, you own the air. And how do you really divide all that? Well, you've got a couple of problems here. One is, if you are managing or you're on the board of a condominium community and it was created after July 1, 1992, so it was created after Kiowa, you are subject to all the requirements Kiowa currently contains with respect to insurance. One of those requirements says condominium communities, the associations are required to insure the actual unit. Doesn't matter what your declaration says. You must insure the unit, but you can exclude your finished surfaces. So things like carpets, hardwood floors, paint, wallpaper, paneling, you can exclude that. And you can exclude homeowner installed improvements. So any upgrades made by homeowners you can exclude. But what you can't exclude then is the drywall, the subflooring, the originally installed counter cabinets, the bathtub, the toilet, all is originally installed, the ceiling fans that were originally installed, anything that was originally installed by the developer that's a fixture, you can't exclude that. All right. You also have to insure the common elements, which means you're going to have to insure the windows in most cases, because windows are defined in Kiowa as common elements unless your declaration chooses to define them as being part of the unit. So if you are part of a condominium complex that is post-Kiowa, you're going to have a rough time. The best you can do is amend your declaration to only insure the unit minus finished services minus homeowner upgrades. Everything else you're required to insure under statute. And you'd want to consult with your attorneys on that one. The other thing is, as I mentioned earlier, how do you sell this to your homeowners? Can you tell your homeowners your assessments will go down? Usually I don't see boards being able to say that. I have seen boards being able to say, well, if we can pass this, your assessments won't go up. And usually those boards have numbers. They basically get with their insurance representative and they figure out how much is it going to cost for next year for us to get insurance. They get some rough numbers as to what the premiums are going to look like, how much they're going to go up, and how much they're going to have to either raise assessments or special assess. And they tell their homeowners, this is what we're going to need to do for next year. So if we want to stay where we are right now and not have to keep going up, we need to do this amendment, and you guys are going to need to vote in favor of it. A lot of times that helps, but ultimately, for those of you who have been through a declaration amendment, it's not an easy or quick thing. So start thinking about it long before you are up for renewal. I have had boards reach out to me and they're like, hey, our insurance is up for renewal next week. Can we do an amendment? I'm like, you're not going to do it in a week? It doesn't work that way. I would give yourself at least 3 to 4 months before you go that route. You want to have as much time as you can possibly get. So if you're thinking about it right now, figure out when your insurance is renewing, talk to your insurance agent, broker, whatever, about what the numbers may look like next year, and start coming up with a sales pitch to your homeowners and talk to your attorney about what you can and can't change and if it's worth it even. Okay, so the next one is amending your declaration to require owners to carry certain minimum insurance in accordance with current criteria of insurance companies. So this is what we were talking about. The insurance companies that are requiring associations to have a specific requirement of owners. And basically, if you have it as a requirement, you are required to enforce it. So if you're telling homeowners you must have a minimum of $1 million liability policy inside your home, now we have the duty to make sure they carry it. So if they don't carry it and someone finds out about it, there is an exposure to liability for the association. If our insurer finds out they're not carrying it and they drop the association for coverage because we didn't comply, there's an exposure to liability to the board because we made this change and we didn't enforce the requirement. So this is why I say be careful, because if this is something the board is going to, take on, so if you're going to propose an amendment requiring homeowners to have this minimum coverage and you actually pass it, you're going to have to figure out a way to enforce it, which means either homeowners are submitting proof of coverage to you every year or something like that. And if they're not, you are going to need to go and start your enforcement proceedings against them, because you're going to need to ensure that they have this to make sure our coverage for the entire community doesn't get dropped. It's scary. My personal take on it is look for another carrier if this is something that's being requested of you by your current carrier. But that's just me. It's easier said than done. All right, adopt a grill or open flame policy. This is, remember we just talked about the grills. If you are with an admitted, Colorado admitted carrier, they are going to require this at some point if they haven't yet, and you adopt the policy. This one, assuming it's a condominium complex where the decks are limited common elements and the balconies are limited common elements, you can definitely do that through a policy. And it does not require homeowner approval, so that's something you can do and adopt and disseminate to the homeowners, and make sure you enforce it, because if you've got an insurance inspector person coming through your community and they see any grills on decks or in patios or anywhere near a building, they are going to tell you that you will be dropped. So this is an important one. This is huge. Get a maintenance and insurance chart to ensure you are not over-insuring, but also, as I said earlier, you are going to get a maintenance and insurance chart that you can give to your insurance person so that when you are looking for coverage, they know exactly what the association needs to insure. That way, you're going to avoid fights down the road when you're submitting claims and you are, and you have the insurance adjuster saying, no, this isn't covered. It's like, yes, it is. We submitted this when we were first bidding on the insurance. You've had this all along, and this is what we're going off. And you never, ever objected to it. So this is what we're insuring. It's a lot harder for insurance to deny coverage once you have one of those on file. Also, insurance agents do appreciate them. They really do. And then also, you know that you're not getting charged necessarily to insure components that are not your responsibility to insure. Okay. So again, important thing. A lot of associations are obtaining policies with higher deductibles. That is unfortunately the situation these days. If you can't shift the burden of insuring, a lot of associations are going to deductibles that are huge. So it's not uncommon. I've seen deductibles of like $100,000. I've seen deductibles of $250,000. And it's very, very unfortunate that associations have to do that. But they have no other choice. They just don't, because they can't afford anything else. Their homeowners can't afford anything else. So, and that is still going to be some sort of a liability exposure for those associations, because they could get accused of not actually carrying the requisite insurance they're supposed to carry, because the deductible is so high that essentially they are self-insuring, which means the homeowners are paying for it. And the scary thing about that situation is that should an owner sue an association based on a claim of failure to insure, those claims are almost always excluded from coverage, which means the association is defending itself in court, paying an attorney out of its own pocket, as opposed to having insurance pay for the coverage. And that's really the expensive part there, is the attorneys. So it's a scary situation to be in, but honestly, I don't know what other options are out there for associations, because this is just not a good market right now. Require replacement of aluminum wiring. Obviously, if your insurer is giving you an ultimatum saying you need to either do this or we're dropping you, obviously you're going to do it. Or if you're not doing it, you're going to be looking for other insurance and probably a surplus line, which again is going to be more expensive. So there's very few options available to you. I want to throw in a couple things that are mentioned on here as well. Performing preventative maintenance is really, really important, because right now insurance is all over that, especially ever since we had the Florida condo collapse. everyone's all over that. Everybody wants to make sure, whether it's like a bank lending money to a purchaser, whether it's insurance, they want to make sure that associations are performing the appropriate upkeep of the buildings, especially with older buildings. It is extremely difficult for older condominiums, especially, to get insurance coverage. So you absolutely want to make sure that you are performing that maintenance. Another thing to consider is, do you have an allocation of deductibles policy right now? Because if you don't, you absolutely need one, because especially with, like, the wind and hail, you want to make sure that if there is a claim that's being submitted, that we know exactly who's responsible for paying that deductible, because otherwise there's also a nice fun trend that the individual owners insurance companies are pretty much assuming that associations are responsible for all deductibles on their policies, unless there's something in our declaration that says we're not, or unless we have a policy that says we're not. So if your community doesn't have an allocation of deductible policy, I would really encourage you to get with your legal counsel and talk about that, and make sure if you don't have language in your specific documents, that you actually have a policy in place, so that you are not accosted by individual owners' policies later telling you you have to pay them. Finally, at least for this page, there is always the option of self-insuring. I have had many associations look at that, and for that you're going to have to crunch numbers and figure out how much it costs to self-insure. But keep in mind, any community created after Kiowa, so after July 1, 1992, you cannot self-insure, because the statute says you are required at a minimum to insure common elements. Okay, you have to insure common elements, and you have to insure it to full replacement value, which means you can't even insure it to half value. You gotta have enough insurance that will be able to pay to restore the entire thing. So we might be stuck. For your older communities, you could look at it, you can crunch the numbers and see. However, if you've got a set of covenants that requires you to insure, that requires you to do full replacement value, you're not going to be able to self-insure unless you amend your declaration. And again, you have to figure out a way to sell that to your homeowners, because what's in it for them if we do this, All right. Next. All right, a few more things to think about. Obtaining an insurance audit to ensure you're not overinsuring. So an insurance audit, I just realized my camera's like not centered. Weird. Okay, so an insurance audit essentially is something that your attorneys would prepare, and it's essentially you're reviewing your governing documents for insurance obligations, reviewing your current insurance policies and all the endorsements, and actually reading through that, giant stack of stuff. God, it's fun. So you read through that, and then you create an actual written report saying, okay, here's what's required, here's what you have, here's what adds up, here's what doesn't match up, here's where you have gaps in coverage, here's where you may be overcovered, here are some opportunities you're missing, here are some gaps, and it's basically all wrapped up into a written report. So that way you will know, one, if you have too much insurance, if you're carrying endorsements that you don't need, if you have too little insurance, which hopefully is not the case, but at least it'll give you a pretty good idea of where you are. And this is really from a legal perspective based on what the law requires you to have and what your documents require you to have and what is industry recommended for you to have versus what you do have. So I always recommend it. Like I said, it's done by attorneys, so you'd have to go to your whoever your HOA practitioner is and ask them about it. Another option is if you are a community that is in the mountains or otherwise surrounded by some kind of vegetation, or like in a fire hazard zone, you could obtain a plan from a qualified expert, which could be a fire chief, a forest service, someone like that, concerning removal of vegetation for fire mitigation purposes, and you could follow that. And then that is something that could be presented to the insurance agent, insurance broker, to show that you're acting in good faith to try and mitigate the damages or the fire exposure of the community. And sometimes it helps to help lower your premium because it shows you're not in as much of a fire hazard area as perhaps other communities in that same perimeter. And finally, most importantly, please, please, please consult with an HOA specialist insurance broker and not just a property insurance broker. I say this every time. I am not an insurance broker. I'm speaking to you from a legal perspective on insurance, but an HOA specialist, you can't substitute that. There's a handful of them in Colorado. There's not that many. So if you're working with someone who says, they're a property insurer or they're like a business insurer, that's not going to be good enough. You want someone who specializes in the HOA world. If you're not sure, you can reach out to your attorneys because it's a small world and we pretty much know most of the brokers who specialize in this area of practice because we run in the same circles, so we could tell you. So please, check with your attorneys if you need to, if you're not sure that, your broker specializes in this, and check with them. Make sure you talk to them about your individual situations, about what else you can do. Is there things you're not thinking of with respect to your situation and the ability to lower your own, premiums, risks, things like that. Because honestly, there's probably a lot of stuff out there that I'm not thinking of, that I can't think of, and that they can. So on that note, so sadistic and yet so funny. I'm going to try and go through the questions because it looks like we got quite a bit. And you can watch the dancing pig and chicken in the meantime. All right. I'm just going to go through these questions. Okay. All right, here we go. Lenders have told us that our 8% wind hail deductible makes our property unwarrantable and therefore difficult to sell at full market value. Will there be an update from Fannie Mae? I know Fannie Mae is always looking at stuff, but I also know that the current insurance deductibles for wind hail, 8% isn't actually that high. I'm seeing typically 10 to 15% right now. So for those of you who are like at between 5 and 10%, you're not actually at the highest rate. So I don't know if that makes you feel better or worse. But some lenders just are also not in touch with the reality of the situation. So even though, I don't know how much Fannie Mae can truly do about that because insurance has nothing to do with Fannie Mae. But we'll keep looking. We'll see. Let's see. All right. I manage several HOAs in Estes Park, so you're in the fire zone. And insurance carriers are now doing ground inspections, including drones, and we need to provide proof of paid invoices that we are complying with the fire mitigation practices. That is a great example of what we just talked about, that yes, you're in a fire zone and insurance is hesitant, and they want to know that you're doing absolutely everything you can to make sure you're protecting the association from exposure to, the fire risk. Yes, so that's a great example. Thank you. If a community consists of single-family homes, but is classified as a condominium due to shared driveways, and the association currently pays for roof insurance, can the association amend the governing documents to make individual homeowners responsible for their own roofs? Possibly. I mean, sometimes, just because it looks like an individual home doesn't mean legally it's a single family home. We would need to look at like the governing documents to see. I mean, you may want to look and just see, because if you see the term lots on there, then that's a good sign that you're dealing with more like single family homes. If you see something like airspace in there, then legally they may still be condominiums. So it depends on really legally what they are classified as and when they were created and how the declaration is written. So it's probably something you want to have your current HOA attorneys take a look at and tell you for sure what you need to do. Let's see. Our insurance company is telling us we can't have a grill within 10 feet of the building. Yep. Our grills sit on a concrete slab and the building is stucco, which is fire resistant. Is there anything we can do to keep our grills? Probably not. They don't really care. And it's like I said, it's something that's going around the state, and they don't care. At that point, you could probably have a brick building and they won't care, and they're going to tell you that you can't have them. And then the follow-up questions: are denied claims counted against you? I think they are still counted against you, because that's actual work that the insurer has to do, because they still have to look into it even though it's denied. And so I do believe they're counted against you, but you probably want to double check with your insurance professional on that. Is there a cost to rewrite the declaration? Yeah, depending on how much you're rewriting, it could get pricey. So again, if you're just changing one or two things, it's going to be far less expensive than rewriting the whole document. So I would suggest you check with your community's HOA attorney to see if you can get a ballpark estimate specific to you and what you want to do. Can a condo complex or cooperative require members to obtain HO6 policy with a loss assessment provision of a certain amount? So again, like we talked about earlier, you could amend your declaration to require that. It would have to be in your declaration. However, as an attorney, I really discourage associations from doing that, because once you make it a requirement, you have to enforce it. And to the extent that someone doesn't do what they're supposed to do, and then there's a claim and they're underinsured, hypothetically, owners can go after the association for that money because we did not enforce our covenants. So I really see it as a senseless and needless exposure to liability for an association, and I would not recommend doing that. But can it be done? Yeah, if you can get the homeowner approval to do that. Can we just have no grills in the declaration, or do we need to police it? Yeah, you're going to have to police it once it's in there. I mean, the board's duty is to basically enforce everything that's in its governing documents. It doesn't matter if you like it or you don't like it. Unfortunately, that is the duty you have. So if you don't enforce it, there is an exposure of liability to the board itself for a breach of its fiduciary duties. So you don't want to put yourself in that position. If you're not going to enforce it, then don't adopt it. All right, sorry, go back here. Can a board pass a policy for rentals only, allowed 7-day minimum without a homeowner discussion or vote? No, anything to do with rentals, so a little bit outside the scope, but anything to do with rentals has to be through a declaration amendment that goes through the homeowners for approval. Can reserves be used for a deductible payment? Technically, yes, unless you have something in your declaration or other governing documents that prohibit using your reserves for deductibles, but I honestly, in all my years of practice, I've not seen that ever. So I'd be very surprised. So yes, reserves can be used for that. Can special assessment coverage, can special assessment coverage be used to satisfy, same question, same answer, nothing's changed. What is the difference between getting a maintenance and insurance chart and an insurance audit? Well, a maintenance and insurance chart is just basically a chart that says, based on your declaration, here is basically a list of all the various components in your community. Here's who has the obligation to maintain and repair each component. Here's who has the obligation to insure each component. An insurance audit is very different in the sense that it actually reviews your insurance policy and it compares what your policy says, and it compares it, one, to what your declaration requires, but also it compares it to industry practice and standards. It looks at your endorsements to make sure that any required endorsements are also covered. So it's a lot more complicated, and it doesn't just tell you what has to be insured by the HOA. It tells you whether your policy is up to par and whether it complies with the statutory requirements of what the policy actually has to look like. So it's two completely different services. Great information. Will this be available? This video, this is recorded. It's going to be on the ACE YouTube channel in the next 48 hours or so. So you are welcome to rewatch that if you really want to. Just block out my face here. We are a townhome complex with shared roofs. What are things to watch out for in insuring roofs when homeowners want solar panels? You want to have an agreement with each homeowner before they put up the solar panel, in which basically they agree to be responsible for any damage to the roofs. They agree to take down the solar panels when we're doing roof maintenance. They hold the association harmless from any damage to their solar panels as a result of anything, really, bad weather as a result of us doing maintenance on the roofs. We want to make sure they don't go after the association for anything at this point. So there's a few different things you probably want to look at. One more question. Is the possibility of litigation against an HOA from a homeowner, in the possibility of litigation against an HOA from a homeowner, what are the things to watch out for and make sure to stay up on so the association insurance doesn't deny coverage for legal fees and representation? Well, ultimately, there's certain things that are going to get denied because they're standard exclusions in policies. There's just some things insurance will not cover. One of those, like I said earlier, is the failure to adequately insure. That is excluded all across the board. There's also contract disputes. That's typically excluded across the board. So there's just certain things that are excluded. So I think it depends on each situation, and you can talk to your individual HOA practitioner, attorney, and maybe they can give you some more specifics on that. We got 2 minutes. I'm going to see if I can get through the rest of the. So if there's an issue with a maintenance item, is a homeowner with a homeowner. Sorry. Okay. If there's an issue with a maintenance item that a homeowner is to maintain, but the HOA insures it, how does that work with a chart? So I only have 1 minute, so it's very difficult to explain, but your insurance kicks in when there is a major catastrophic event. Normal repairs for like wear and tear are considered maintenance. So when you've got something that needs to be repaired because of its wear and tear, and there's no catastrophic event, then that's just going to go to that homeowner in that case. If we have a catastrophic event that causes the damage, then the association, if it insures it, would have the obligation to submit a claim to its carrier. That's the long and short of it, but we teach classes on this that go forever, so it doesn't do it justice. I apologize. Okay, it's 1 o'clock. In interest of everyone's time and respect for all your times, thank you so much for attending this webinar. I hope it helped you at least a little bit, and we'll see you next time. Thanks, everyone.